Hey, what's going on, everyone? It's Sunny and So Sovereign. I have Money Matters Chapter 2 quiz up. I would highly recommend to go over the quiz before going through the Chapter 2 video. That way we understand exactly what we're looking for. It is a pretty easy quiz, got a couple of trick questions in there, but overall it is straightforward. Again, before going through the video, I will highly recommend to just glance over the quiz. And yeah, without further ado, I hope you guys enjoy the video. What's going on, everyone? It's Sunny and So Sovereign. I'm back. I'm happy to be back here teaching Money Matters, where we are learning about the evolution of money from barter to Bitcoin. Last time in chapter 1, we talked about the functions of money, the characteristics of money, and the different forms money takes. We also went over our mission statement to give a clearer view onto why we're here, explaining what we're explaining, why we're talking about money. So yeah, I'm definitely happy to be back. Today we'll be talking about barter systems, commodity money systems, and lastly, fiat money systems. We'll be going over some history, some American history, so we can understand as to how we got to where we are today. So without further ado, let's jump right into it. Chapter 2. What is bartering? In a barter economy, goods and services are exchanged directly without a common medium of exchange like money. For a successful barter transaction to occur, both parties involved must have exactly what the other wants. This is the double coincidence of wants, meaning party A must have a good or service that party B wants. Party B must simultaneously have a good or service that party A wants. Imagine a farmer who produces wheat and a shoemaker who makes shoes. The farmer needs shoes, the shoemaker needs wheat. For them to trade, the farmers must want the shoes at the same time the shoemaker wants the wheat. If either party doesn't desire what the other has, or if the quantity does not match or timing is off, the trade cannot happen. So again, what was the solution? Localized currency was the solution to these problems. But over time, as communities grew larger and nations were built, the need for a standardized and widely accepted form of currency led to the introduction of metal coins, with fixed weights simplifying transactions. As trade grew more complex, Mesopotamians developed ledger systems to track transactions, forming one of the earliest financial systems that utilized tokens and ledgers. Again, that civilization was called the Mesopotamians. They were, as far as we know, the earliest civilization to use a ledger system. However, metal coins themselves posed challenges. They were heavy and susceptible to counterfeiting, leading to the inflation and loss of purchasing power and overall trust. To address these issues, communities turned to paper receipts. These receipts were backed by and easily converted into gold kept in vaults in all major societies. They provided a portable and easily transferable form of currency while maintaining the value and security of gold. During this time period, known as the Gold Standard era, paper receipts served as evidence of ownership or claims to a certain amount of gold held in vaults or banks. When individuals deposited their gold into these institutions, they received paper receipts in return. If they wanted to convert their paper receipts back into the physical gold, they could do so by presenting their claims to the vault or bank. In summary, the use of paper receipts backed by gold allowed for a portable and easily transferable form of currency while maintaining the value and security of the underlying assets. The conversion process involved transferring ownership rights to the gold, with vaults or banks managing the accounting and balancing of reserves and paper claims. Now, transition from sound money to unsound money. Fast forward to the 1900s, where reliance on banks became the norm. However, a growing unease emerged as banks issued more paper receipts than their gold reserves, essentially creating more money than they had tangible assets to support. Meanwhile, inflation and strict monetary policies compounded economic challenges, often burdening the lower and middle classes. I know that all too well. Before the Federal Reserve Act of 1913 in the United States, the issuance of money varied depending on the historical context and the region. Here are some examples. Gold and silver standard. Many countries, including the United States, operated on a gold or silver standard. Under this system, the government issued currency backed by a specific amount of gold or silver held in reserves, providing confidence in the currency's value. We also have privately owned banks. Before the establishment of central banks like the Federal Reserve, private banks, including smaller regional banks, played a significant role in issuing money. These banks issued banknotes, which were promissory notes redeemable for gold or silver upon demand. These banknotes circulated as a form of currency within the economy, although their acceptance varied regionally. We also had government we also had government issued money. In some cases, particularly during times of war or financial crisis, governments directly issued paper money to finance their activities. These government issued notes, known as fiat money, were backed by government's authority rather than by a commodity like gold or silver. Local currencies, in addition to national currencies issued by central authorities or private banks, local communities sometimes use their own form of currency. These could include tokens issued by local businesses or even informal systems of credit and barter. Overall, the monetary system before the establishment of the Federal Reserve was diverse and often decentralized, with various entities issuing different forms of currency. Now we're going to go into the need for a central bank. I went ahead and Googled some crises before the establishment of the central bank to get a good idea as to why such entity was needed. I found some, I got 1, 2, 3, 4, 5, 6 crises here before 1913, the establishment of the Federal Reserve. And there's probably more. I'm pretty sure there's more. I would highly recommend for everyone to do their own research.
Panic of 1819. The Panic of 1819 was one of the first major financial crises in the United States, triggered by the collapse in land prices and a decline in demand for American agriculture products. It led to widespread bank failures and economic depression. The impact it had: many banks failed, unemployment rose, and there were widespread bankruptcies. The crisis revealed the weakness in the American banking system and the need for a more robust financial regulation. We have the Panic of 1837. This financial crisis was triggered by speculative lending practices, the collapse of a land bubble, and restrictive monetary policies enacted by Andrew Jackson, including the Specie Circular, which required payment for government land to be in gold and or silver. The Panic of 1837 led to severe economic depression that lasted for several years. Banks failed in large numbers, and there was a significant decline in business activity and employment. We have the Panic of 1857. The Panic of 1857 was caused by the collapse of the Ohio Life Insurance and Trust Company, along with declining international economic conditions and a decrease in the value of American agriculture exports. The impact it had: this crisis resulted in bank failures, a sharp drop in stock prices, and a significant economic downturn. The effects were particularly severe in the northern states and contributed to economic tensions leading to the Civil War. We also have the Panic of 1873, known as the Long Depression. This panic was triggered by the collapse of J. Cook and Company, a major investment bank, following the overextension of railroad investments. The impact it had: the Panic of 1873 led to a prolonged economic depression that lasted for several years, characterized by widespread unemployment, bank failures, and deflation. We're starting to see a pattern here, are we? Okay, we have the Panic of 1893. The Panic of 1893 was precipitated by the collapse of railroad overbuilding and a shaky railroad financing, which set off series of bank failures. The crisis resulted in severe economic depression with high unemployment, significant deflation, and widespread bank and business failures. It was one of the worst economic depressions in U.S. history. We also have the Panic of 1907, right before the establishment of the Federal Reserve in 1913. The Panic of 1907, also known as the Knickerbocker Crisis. The Panic of 1907 was triggered by the collapse of the Knickerbocker Trust Company and series of bank runs. The impact: the panic caused widespread bank failures, a sharp drop in stock market prices, and a significant economic downturn. It highlighted the need for a central banking system to provide liquidity and stability to a financial system. After all those crises, I would want some kind of centralized entity to take all the responsibility and accountability for my mess ups as well. Conclusion: the recurring financial crisis and banking panics before 1913 revealed significant weaknesses in the American banking system and the lack of a central regulatory authority. These hardships ultimately led to the establishment of the Federal Reserve, designed to provide greater financial stability, manage the money supply, and act as a lender of last resort to prevent bank failures and stabilize the economy. Now, the introduction of the Federal Reserve centralized much of this authority under a single institution, responsible for regulating the money supply and overseeing banking system. Trust between this private institution, the Federal Reserve, governments, and individuals tend to thrive during time of peace and economic stability or growth. However, during periods of uncertainty, there has historically been a tendency for people to prefer holding gold. They kept enough necessities for a certain period, but stored everything else in gold to preserve their wealth and hedge against inflation caused by centralized institution and or government. This reluctance to exchange currency for gold and vice versa stems from several factors: economic instability, trade imbalances, and policy restrictions.
All right, so now that we got done, now those were the crises that led to the need for the Federal Reserve. Now I would like to talk about the years from after the establishment of the Federal Reserve all the way to the early 1970s, when we were completely off the gold standard, and just to get a better idea as to how our economy, how the United States reacted to having a centralized monetary system, monetary entity that controls money supply, etc. So let's get right into it. Let's see here. More details on interwar period. So this period is going to be between the end of World War I all the way to the beginning of World War II, just to get a better idea as to how the economies again reacted to having a Federal Reserve. Economic instability in the U.S. during the interwar period, 1918 through 1939. The interwar period in the United States was marked by significant economic challenges and instability. This period, spanning from the end of World War I to the beginning of World War II, witnessed a series of economic events that had a profound impact on the American economy and society. Aftermath of World War I, 1918 through 1920s. Economic boom and bust. The end of World War I, 1914 through 1918, brought an initial economic boom as the United States transitioned from a wartime to a peacetime economy. However, this boom was quickly followed by a recession in 1920 through 1921 as the economy adjusted to post-war conditions. Inflation and deflation. The immediate post-war period saw significant inflation as wartime price controls were lifted and demand outstripped supply. This was followed by deflation during the recession of 1920 through 1921, which caused economic hardships for many Americans. The Roaring Twenties, 1920 through 1929. Economic prosperity. The 1920s, often referred as to the Roaring Twenties, was a decade of economic growth and prosperity in the United States. Industrial production soared, technological advancements flourished, and consumer goods became more widely available. The stock market experienced unprecedented growth, and speculative investments were rampant. Income inequality. Despite overall economic growth, income inequality widened significantly. While urban areas and the upper class enjoyed prosperity, rural areas and lower income population faced economic difficulties. Credit and speculation. Easy credit and speculative investments fueled a stock market bubble. Many Americans borrowed money to invest in the stock market, leading to an unsustainable rise in stock prices. The Great Depression, 1929 through 1939. Stock market crash of 1929. The speculative bubble burst in October 1929, leading to the stock market crash known as Black Tuesday. The crash wiped out billions of dollars in wealth and triggered a severe economic downturn. Bank failures. Despite the establishment of the Federal Reserve in 1913, the banking system faced significant challenges, with thousands of banks failing between 1930 and 1933. Bank runs were common as people rushed to withdraw their deposits, leading to further bank failures. Unemployment and poverty. Unemployment soared to around 25%, and millions of Americans were plunged into poverty. Breadlines, soup kitchens, and shanty towns known as Hoovervilles became common sights. Deflation. The Great Depression was marked by deflation, where prices fell, leading to reduced consumer spending and further economic decline. Farmers were particularly hit hard as agriculture prices plummeted, making it difficult to cover their costs. New Deal policies. In response to the economic crises, President Franklin D. Roosevelt implemented the New Deal, a series of programs and policies aimed at providing relief, recovery, and reform. The New Deal included measures to stabilize the banking system, provide unemployment relief, and stimulate economic growth, such as the Securities Act of 1933, the Securities and Exchange Act of 1934, and the Social Security Act of 1935, to name a few. Rise of totalitarian regimes in Europe. Global impact. The economic instability of the interwar period was not confined to the United States. Europe also faced significant economic challenges, contributing to political instability and the rise of totalitarian regimes. American isolationism. The rise of totalitarian regimes and the threat of another global conflict led to a period of American isolationism. The United States focused on addressing domestic economic issues while avoiding entanglement in European affairs. This period of isolationism ended with the outbreak of World War II, 1939 to 1945. Conclusion. The interwar period in the United States was characterized by significant economic volatility, marked by the initial post-World War I recession, the prosperity and excesses of the Roaring '20, and the devastating impact of the Great Depression. Despite the establishment of the Federal Reserve in 1913, the recurring economic challenges highlighted the need for stronger regulatory mechanisms. These hardships ultimately led to the implementation of new policy deals to provide greater economic stability and security. To tackle some of these issues, this is what the U.S. government decided to do. In 1944, the Bretton Woods system was established, pegging currencies to the U.S. dollar convertible to gold at a fixed rate. This arrangement stabilizes exchange rates and boosts monetary system confidence. Monitoring and regulation. Institutions like the IMF and the World Bank are set up to oversee the international monetary system, monitoring exchange rates and coordinating policies. Despite these efforts, challenges persisted. Trade imbalances, inflation, and the Vietnam War, 1955 through 1975, strained the Bretton Woods system. In 1971, President Nixon's suspension of the dollar-gold convertibility signals its end, ushering in floating exchange rates and a modern monetary system. This shift marks the end of the gold standard and beginning of a new era of flexibility and disorder. End of fixed exchange rates. The collapse of the Bretton Woods sees the abandonment of fixed rates, allowing currencies to fluctuate freely. Increased flexibility. Central banks gain leeway in managing monetary policies, adjusting interest rates, and intervening in currency markets. Inflationary pressures. Without gold convertibility, central bank resorts to printing money, leading to currency depreciation and rising prices. Fast forward to 2024. Abuse of centralization. Despite efforts to improve the quality of life through things such as modern monetary systems, increased efficiencies like our mobile banking and e-commerce, greater access to information, and enhanced communications like the internet, the majority of people's standards of living begin to decline due to abuse of centralization, rising prices, stagnated real wages, and weakening currencies. The need to spend more money for fewer things. This has challenges for those with lower economic resources who may have limited access to education, credit, resources, social networks, and political representation, leading to potential disadvantages in their ability to succeed. As a result, the rich seems to get richer and the poor seems to keep getting poorer. In the words of Friedrich A. Hayek, I don't believe we shall ever have good money again until we take the thing out of the hands of government. All we can do is by some sly roundabout way introduce something they cannot stop. Where are we today? Today we come a long way from the first credit cards introduced in the 1950s. With a simple swipe of plastic, we can buy whatever we want, whenever we want, without any hassle. Little did we know that our reliance on credit card will have painful after effects, like raising the overall cost of goods and the complete loss of privacy for all electronic or digital transactions. The price of control. The rise of a cashless society. A look at surveillance, capital control, and regulation and censorship. When the first credit card was introduced in the 1950s, people rejoiced at the thought of never having to carry around actual cash again. No more fumbling for loose change or awkward check writing moments at the checkout counter. All those intermediaries can now take their cut without you even realizing it. Just like a toll on a network. The convenience of modern finance. But with the rise of digital currencies like CBDCs, it's like we've gone from paying a fee for using the network to having to ask permission. Worse, now we expect to be searched, scanned, and scrutinized by the government every time we pass through. Control and surveillance have taken the place of convenience. And just like the fee from the network, these intrusions into our financial lives come with a cost, whether it's monetary, a violation of privacy, or a loss of autonomy. As more of our daily transactions move online, the use of cash declines. Governments and financial institutions around the world are promoting the use of electronic payments and cracking down on the use of physical money. This trend has sparked a debate about the future of cash and the potential consequences of a cashless society. The question is, are we willing to pay the price for the convenience of modern finance? Or will we seek alternative options that prioritize our freedom and privacy? The war on cash refers to various efforts to reduce the use of physical money, remove high denomination bills, and promote the use of electronic payments. Proponents of the war on cash argue that it will make transactions faster, more convenient, and more secure. Governments and central banks are advocating for the elimination of cash to make it easier to track all types of transactions, including those made by criminals. Criminals and terrorists benefit from the privacy and ease of illegal transactions facilitated by large denominations of banknotes. However, citizens are concerned about the potential repercussions on the economy and social liberties if physical cash is coercively eliminated. The push towards a cashless society is supported by advancements in technology such as online banking, encryption, smartphone, and payment technologies. By 2015, there were 426 billion cashless transactions worldwide, a 50% increase from the 5 years prior. Lawmakers argue that removing high denominations of bills from circulation would hinder illegal activities and enhance efficiency in transactions. Cashless transactions are faster, more efficient, and incur fewer costs for banks. Central banks could also exercise greater control over interest rates to manage inflation, including implementing zero interest rate policy and negative interest rate policy. However, the war on cash may have unintended consequences. Cashless transactions would involve intermediaries increasing government access to personal transactions and records. Certain types of transactions could be restricted or frozen by governments, potentially driving people towards decentralized cryptocurrencies alternatives. A cashless society would limit individual freedom to store wealth outside of the system, making savers vulnerable to bank bail-in scenarios and extreme monetary events. The rapid increase in digital transaction and government stimulus programs highlighted the potential vulnerabilities and privacy concerns associated with a cashless society. As the U.S. increasingly adopts digital payment systems, concerns about privacy and security have come to the forefront. Digital transactions leave a traceable record, making it easier for both the government and private companies to monitor and analyze individual spending habits. This level of surveillance can lead to a loss of personal autonomy and privacy, as every financial transaction becomes potentially subject to scrutiny. The convenience of digital payments comes at a cost of increased exposure to data breaches and cyber attacks, which can compromise sensitive financial information and personal identities. As governments and central banks continue to promote the transition to a cashless society, it's essential to consider the potential trade-offs and unintended consequences for individuals and society as a whole. So let's look at some of these trade-offs. A look at surveillance, capital control, and regulation censorship. Surveillance. Surveillance is a tricky business. On the one hand, it helps catch people doing bad things like money laundering, but the more fraud that happens, the more surveillance needed, which can lead to invasions of privacy through technology. Private companies may also collect and trade your personal information for their own benefit, and the risks of surveillance can include scams, harassments, extortion, identity theft, and even tracking your car purchases. Plus, with the rise of AI and machine learning, it's becoming even easier for governments and companies to evade our privacy. Moreover, it's often the people who are already disadvantaged or underprivileged who are hit the hardest. Capital control. When spending gets out of control, governments may impose price controls to try and fix the problem. But sometimes these controls make things worse. Consider the impact of the Federal Reserve monetary policies on financial accessibility in the United States. During the COVID-19 pandemic, the Federal Reserve implemented unprecedented measures to stabilize the economy, including lower interest rates to near zero and purchasing large amounts of government and corporate bonds. While these actions were intended to support the economy, they also had unintended consequences. For instance, small businesses and individuals face challenges in accessing loans and credit, as banks tightened lending standards due to economic uncertainty. Financial regulations and censorship. Financial regulation and censorship can be financially and emotionally taxing realities for societies and their citizens. They manifest in various ways, such as capital controls that limit how much money individuals can transfer or withdraw, debanking practices where financial institutions terminate accounts for those in high risk or controversial industries, and underbanking practices that underserve individuals and in redline communities, limiting their access to essential financial services. Redline communities refers to neighborhoods marked as high risk for mortgage lending, often based on racial or socio-economical factors. This practice historically denied residents access to loans and insurance, leading to disinvestment and economic decline. As a result, these communities often struggle with limited access to banking services, impacting their financial opportunities and overall economic health. For example, following Operation Choke Point, a 2013 initiative by the U.S. Department of Justice, many banks were pressured to sever ties with businesses in certain high-risk sectors to combat fraud and money laundering. Although the operation officially ended in 2017, its impact is still felt as banks continue to exercise caution and may deny services to legitimate businesses to avoid regulatory scrutiny. These practices raise significant concerns about financial censorship and overreach of regulatory measures. Individuals and businesses affected by debanking can find themselves unable to access essential financial services, which can cripple their operation and limit their economic opportunities. The lack of transparency in the decision-making process of financial institutions further exacerbates these issues, leaving customers with little resources or explanation for the termination of their accounts. In the U.S., as of 2021, approximately 4.5% of households, about 5.9 million households, were unbanked, meaning no one in the household had a checking or savings account at a bank or credit union. Additionally, around 14.1% of households, close to 19 million people, were underbanked, having a bank account but also using alternative financial services outside of the banking system, such as a payday loans or check cashing services, money orders, or pawn shops. These populations face significant barriers to accessing traditional financial services, limiting their ability to save, borrow, and invest, and thereby exacerbating economic inequalities. Conclusion. Overall, the move towards a cashless society and the increased prevalence of debanking, underbanking, highlight the delicate balance between maintaining financial security and protecting individual freedoms. As digital transactions become the norm, it is crucial to address these vulnerabilities and ensure that financial regulation does not infringe upon privacy and the right to participate in the economy.